Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, welcome back once again, Art Jarvis, as we, take a look at what's happening right now. But 2 weeks ago, Art, we left off talking about the fact that maybe the market, maybe we're getting a little ahead of ourselves with the rebound. So how about now, 2 weeks later, what's happening?
It's funny you mention that. We actually pulled back a little bit here in the last couple of weeks. We were in that 4,300 range, back a couple of weeks ago, and getting real close to 4,400. We actually climbed above 4,400 up to almost 4,455, and then guess what? Next thing you know, we pulled back down into that 4,300 range. So I think I said there's a such thing as too far, too fast. So it's a healthy thing for the market to take a little bit of breather, consolidate maybe a little bit, and then kind of create a foundation for a future leg up in the market. So that's perfectly normal, and it's a healthy thing.
Do you see anything, since we had that conversation 2 weeks ago, what are the factors that contributed? Why maybe did the market pull back a little bit? Is there some reasons that happened?
The last couple times we talked, it really was kind of a lot of discussion about the debt ceiling. So I think there was the ability for the market to push it up because we really were seeing some pretty decent economic numbers. We were seeing the corporate earnings projections moving up at a pretty good clip, but we had this big threat of default on our debt and things like that hanging over our heads. And once that was taken away, that's what allowed the market to take off. And again, there's always the fundamentals of the market. There's the quantitative part, the qualitative part, but a lot of times the big thing is the psychological part of the markets. And we talked about fear and greed, but you took away a big piece of fear when we took away the debt ceiling concerns, and that allowed people to be a little less concerned. And if they were sitting with some more money on the sidelines, that gave them the opportunity to jump back into the market. And we saw how quickly, really, it was just a few months ago we were at 3,800 on the S&P, and how quickly we got to 4,400 on the S&P in just a 3 months' time.
You mentioned the psychological aspect. As somebody who participates, but I'm not the financial guy that you are or others like you are. It's all psychological. It's all me being excited about maybe a little bit of a bull run. So why is it that I should be okay, whoever I am? Why is it I or we should be okay with a little bit of a pullback? Why is the pullback good? What does that really mean?
From one standpoint, a pullback is an opportunity if you miss that initial pop up. If you are sitting on the sidelines, that is one opportunity to get into the market. So if you've been sitting for, some people have been sitting on a lot of cash here for an extended period of time, this pullback is an opportunity for you maybe to get back into the market, maybe not as cheap as it was 3 months ago, but get back into the market at a cheaper level than it was a week or so ago. There's a whole lot that goes into that, but at least it's from a psychological standpoint, it's an opportunity to get in I won't say on the cheap or in the cheap, but it's a chance to at least spend and get a little more bang for your buck. It's sorry, lost my train of thought.
I'm going to throw this in while you regain that moment of thought. So in a simpler term, and maybe it's way too simple, it still comes down to that simple theory of, buy low and sell high. And so maybe for people, as you said, who sat on the sidelines a little bit, or we're sitting with some money waiting, this pullback is an opportunity. Okay, there's a chance to, as you said, not get in on the cheap, but buy a little bit lower because it's pulled back some.
Exactly, and that's precisely it. The thing is, you talk about psychology. If there was no market psychology, this would be a relatively easy business, right? Here's what's normal, here's what's a little bit beyond normal, and if we're a little bit beyond normal, we need to get back toward normal, right? But market psychology is what can take a market and push it 1, 2, 3 standard deviations above or below what you might consider normal. Now, there's also, again, I've said many times, there's thousands of Art Jarvises running around out there, and we all have a different opinion of what normal is. But at some point, if you're 3 standard deviations past what you believe normal is, then we all kind of start to agree on, okay, we might be a little too far in one direction or the other.
Well, and that brings us to where we started today, that it has pulled back a little bit, and just 2 weeks ago the thought was, are we getting ahead of ourselves, as you said? So hopefully it's as good as you say it is to have a little bit of a pullback. I'm going to trust you. I hope others will as well. And I know you're not saying, hey, do this or don't do that specifically. We're talking in a lot of generalizations about what's happening in the financial marketplace, and just to make sure people don't get confused that you or even me as part of this, we're not saying do this and don't do that. We're just talking about what is happening. So
yeah, I mean, there's a whole investment plan, there's investment policy, there's a whole lot that goes into this. We're talking about the market in general, right? So it's interesting to me is the market pulled back. Well, why did the market pull back? I mean, was there some specific set of news? I mean, we got through the debt ceiling discussion. Well, I think as we discussed a couple of weeks ago, guess what? Now we're talking about recessions again. Are we going to have a recession? What's the ability of the Federal Reserve to deal with with a recession? Where are interest rates, and where's inflation going to be? If we were at 8-9% inflation, the ability for the Fed to deal with a recession is much more limited than if we're sitting down at 3 or 4% inflation. And again, the discussion still continues. Janet Yellen came out, the Fed secretary. She came out, said that she believes the potential for a recession is less now than it was, just recently. But yet then you still have other people saying that they still believe that we're going to hit a recession at the end of this year, which maybe I don't necessarily agree with. But at least our ability today compared to a year ago to deal with an economy that's slipping or actually goes into negative territory is a little bit better today than what it was a year ago. So, yeah. We take one piece. There's a saying that the market climbs a wall of worry. Well, that's the truth. We get one thing off the table and we quit worrying about it, but now we can go back to worrying about other things, right? So,
where's the next rock on the rock wall where I'm going to get my footing?
You know what? Again, if we're trying to get a footing, continue to work our way upward up that wall. I still believe. You look at something. I mentioned corporate earnings before. Corporate earnings continue to improve, so that's a positive. Inflation, where it might not be where the Fed wants it to be, it is improving. You look at unemployment. Unemployment has continued to improve, and we're at the lowest level we've been at for a decade. So that to me, in my mind, until I see something different, is to use your analogy, is a solid foothold to push our way up a little bit further. The other thing is consumer spending. You look at gross domestic product. The definition of a recession is 2 quarters in a row of declining gross domestic product. Well, guess what? The consumer is 66 to 70% of that gross domestic product. Well, guess what? Consumer spending is still hanging in there, and actually the May report for consumer confidence came out. Consumer confidence actually increased in the month of May. So it's not, maybe things aren't where people want them to be exactly. I still make the argument that things are continuing to improve.
What do you say? There's a couple things, and I just heard something. A discussion, that was specific to a group of people employed and the kind of wage increase or the kind of raises they were going to get in this portion of the world industry or whatever. What do you say because of the inflation rate? What do you say to those that are like, okay, my industry just offered basically across the board, 3% pay raise increase. Well, that's a cut in pay because, how do you respond to that in terms of its, where's the positive we find in that? And then I'm also going to ask you this, Art. You used that word at the beginning of the conversation, this most recent portion of this conversation, that word recession, which we hate to hear. So we're going to talk some more about that in a second. But what do you say to the people that are concerned about, their pay increase is a certain percentage, but maybe it's not staying with the rate of inflation? How do we get through that?
Yeah, it's no fun. Let's put it that way. It's you get your 3%, but your bottle of milk went up 4%. You're 1% behind, and that's when you talk about nominal increases or you talk about real numbers. And the real numbers are, if you get that 3%, you are at this moment in time, based on the consumer price index, you're behind the ball on that. The one, if I was going to extract a positive from this though, is based on where the employment market is. If you are an employee, the opportunity to go somewhere else and increase your pay is very good right now. I mean, you have, people are having trouble finding employees in a very vast swath of the markets, and it's very easy to yank someone of quality from another company and bring them over to your company, and you end up making more money. So that's, I guess, if you have to battle, that's the other way of battling inflation, is just being upwardly mobile, if that's a good way of putting it.
I think that's the term that would be used, as being, or at least being flexible in, where you can work or what skills you have to be able to, as you said, be upwardly mobile. There was another question that came to my mind, and now it's slipped my mind. It was, I know, you were talking about the best unemployment numbers in like a decade.
Correct.
So I'm guilty myself, Art, of being one of those that's like, the unemployment numbers are low, but what are the jobs? That's where, like, the doubters, and I said I have to categorize myself in that class of, okay, well, that's fine, but what kinds of jobs? I mean, just because, people are being employed, but are they being employed at what might be called, sustainable wages, life-sustaining wages, or are some of those jobs that are falling in that category, not really sustainable wage earning jobs?
Yeah. Yeah, I mean, that's a great question. The answer is yeah. I mean, that is part of it. But I think, if we went for at least a decade where really the manufacturers and the service industries it was not easy to increase prices, right? So we weren't seeing that much inflation, and that was because there are other things such as the internet and things where that was keeping prices down. So if I needed to increase my prices by 5%, it was not something that was easy to do. Now we have had in the last 2 or 3 years, we've had a huge increase in wages and things like that, and obviously, if you go out and buy a cheeseburger today, you know right away, or you go to the grocery store, you know right away that they are now passing those increases on. There's no doubt about that, and that has increased, the wages across the board, really, especially on the lower end. But there's a great argument here. I'm not going to get into it, but it's if you increase the cost of a cheeseburger, guess what? Because now we all have to buy our groceries and we have to buy certain things. Well, that's great that I got a pay increase, but I'm also paying a lot more for things. So, and the other part of it is you look at housing and things like that. I just had this conversation this morning with a client, and their monthly mortgage was $1,000 a month, and now they moved and bought another house. Well, guess what? Their monthly mortgage is $2,000 a month now. That's a substantial difference in your monthly expenses when you've got one piece of the puzzle, a big piece of the puzzle that has basically doubled in the last year or two.
That it's interesting that you jumped to that, because while you were talking about, hey, if a cheeseburger's gone up in price and that means the wage goes up too, well, but now you got to pay for the more expensive cheeseburger. Exactly what I was going to say is, well, and then we've talked a little bit about the real estate market, and a couple of weeks ago or even a month ago, in taking stock. And so that was going to be my question. It's like, well, yeah, but how about the housing market? Yeah, the houses are selling for more than ever. The real estate market is great. But if you sell your home, now you've got to go buy one to replace it at a higher price too. So it's, like you said, it just, the cheeseburger's more, the wage is more, but the cheeseburger's more. The house sells for more, but the house you got to buy is selling for more as well. So you're paying more. But
yeah. The problem with psychology in the market and things like that is, we as human beings have a very short memory. And to be honest with you, I feel that we are in the process of repeating a number of the mistakes that we made back in like 2008. So right before we went into, and again, right before we went into the Great Recession, into the financial crisis. I'm not saying the numbers and things like that are different right now. So I'm not saying we're going into a financial crisis, but it's interesting to me how quickly we go back to making the same mistakes that we were making back in 2008 with how we gave out loans and who we were giving loans to and what their percentages and what their ratios look like and things like that. We're now here we are all of a sudden, inventory is very, very low in the real estate market, and people are paying thousands and thousands and thousands of dollars more for a house, even higher than what the asking price was. And at the same time, they're not doing inspections, and there's no contingency. It's like, if you want this house, you're going to have to pay more than what I'm asking, and I don't want any trouble out of you. Right. So, it's kind of interesting. It's like, okay, now here we are, maybe buying a house that maybe is going to be on the higher end of what we can afford, and we're paying more for it than what it's really worth, and we're paying a higher interest rate. We're paying, instead of paying 3% on the mortgage rate, we're paying 7% on the mortgage rate right now, and you just kind of look back and you kind of scratch your head, like, these are things that long term are not good. If I'm doing my monthly budget at home and I'm spending way more on my mortgage every month than I should be, guess what? That takes away from where I spend other money. That takes away from my discretionary purchases. That takes away from my splurge purchases and things like that. So, sorry, I got a little long-winded on that one, but we continue to march down a path sometimes we should not be marching down.
That and it's okay that you went long-winded. The idea is getting the message across of what's happening, and so if it takes a little bit of a few extra words, so be it. I know, you're in the business, so you're looking at things that I don't even have the question for you sitting in front of me or bouncing around in my mind. What are some of what kinds of analysis? I think, we were talking, just you and I talking, not for the show, but it seems to me you talked about doing some analysis recently. What kinds of things are you seeing, and what kinds of analysis are you doing?
Yeah, actually, that's a great question. I did something for a client last week, and we were talking about the month of May. And, it's like the impression was the month of May was a good month, but there really wasn't as much of movement in the portfolio as well. And so I went back, and it gets into this. We've had a pretty nice move up in the markets in 2023, but at the same time, you kind of look at things, and it doesn't feel as good as you think it should. And so I went back and just our S&P 500, our indexes, the things we compare ourselves to market-wise, the Dow Jones, the S&P 500, the Russell 2000, the NASDAQ 100, those are all indexes or benchmarks that we compare ourselves to. The interesting thing is there's two ways of looking at all those indexes. One is from a capitalization weighted standpoint, which means the companies that are the bigger companies, the ones that are $1 trillion company or hundreds of billions of dollars company, have a greater impact on that capitalization weighted index. So, we, especially in the month of May, we saw something where a lot of the bigger tech companies actually drove up those capitalization weighted indexes, but NVIDIA might be a great example of that. NVIDIA, I think, jumped up like 25% in one day. Well, that had a big impact on the S&P 500, the Russell 2000, or the NASDAQ 100. But if you take those indexes and they actually have what they call equal weighted indexes, whereas let's say the market was up 3 or 4%. If you take that index and look at it from an equal weighted standpoint, it might actually have been down 2 to 4%. So when you start looking at the markets and you start looking at performance in the markets, it's nice to see these indexes moving upward. But really, when you start to look at things from a broad-based standpoint, they really have not moved near as much as it looks like. So when they come up and say the S&P 500's up, whatever it is, 8 or 9% in 2023, the fact is that's not really a very clear indication of what the markets have actually been doing. So there's two ways of looking at that. It's, number one, okay, maybe the markets, they're not doing as well as you think they are. But then at the same time, I'd still make the argument that there are a whole bunch of companies out there that still have the opportunity to start to move up. So hopefully what happens here over the coming months or the rest of this year, we'll actually start to see a little bit more of a broad-based move up in the markets.
What are the things, as we're nearing the end of this week's episode of Taking Stock, what are the things that just all of us out here, whether it's savings or if we're actually investing, what are the things to be looking to right now that are going to give us that opportunity, that are going to look different on our on our quarterly reports or within our portfolio as investors? What are the things that we should be looking at, or that you're seeing right now that are the positives to take away?
Yeah, we've talked about this in the past weeks. Number one, my biggest argument for the positive side is that the economics numbers still look good, and I believe in most cases are still improving. So that's number one. Number two, the earnings numbers, the earnings projections, the forward earnings projections, what our expectations are for earnings going forward, continue to improve. So, I look at things from a very long-term perspective. So I always tell my clients, if I purchase something, on average, I might hold something for 3 to 5 years, depending on how it performs. If I sell something, it's probably because it got way ahead of itself, and it might be 3 to 5 years before you see it come back in the portfolio. So, but yeah, from a positive standpoint, I just don't see from an economic standpoint yet this argument for recession. So I ignore that. The other thing is we live the information technology world that we live in today. We have news organizations, whether it's print or online or on TV, that they have to put together 12 to 18 hours a day of news, and they have to report on something. So we're being constantly seeing a constant barrage of information coming at us, and it's a lot of it's conflicting. So you'll see one person saying everything's great, and see someone else saying everything, the world's coming to an end. But you just have to look at things from a long-term perspective. So if I'm looking at my portfolio and things like that, you got to look at it from a long-term perspective. So I think that's the big thing.
Yeah, and the simplified form of that is, and it's a common theme, every couple of weeks when we stop and, we're taking stock with Art Jarvis here, it's the reminder to, stay calm, maybe slight adjustments in your portfolio, but you do that with whoever your investment advisor is and ask those questions. And there's no reason right now, like I said earlier, as you mentioned that, we hate to hear that word recession, but I'm glad you talked through that the way you did in today's episode about taking stock. And just a reminder for the people, stay calm. There's really, would you say, there's no reason for us to panic. Things are moving in the right direction economically and in the financial markets right now.
Sure. And again, we've talked about the definition of a recession. Technically, if the U.S. economy goes down 0.1% 2 quarters in a row, technically you're in a recession. So you start to talk about the depth of a recession, and people are pretty smart. If you're out at the movies and you're out at dinner and you're going to the grocery store and you can see whether people are pulling back or not. If you start going places and you're like, okay, where is everybody? That's a pretty good indication that maybe something coming down the pike that we're not going to enjoy. But if you continue to go to a restaurant, you got to wait to be seated, and you go to the ballpark and it's full. Of course, it's full right now because we're doing so well. But it's you just go in places. There's a gentleman named Peter Lynch back in the 80s and 90s, and he ran the Fidelity Magellan Mutual Fund. And he always talked about going to the mall and sitting in the mall and watching people go into the stores and then watching them come out. And, you could judge pretty easy how things were going by how many packages people were carrying out of the store, or whether or not they were even carrying anything out of the store. So, again, being long-winded today. But, it's an opportunity. You'll see if things start to pull back, you'll see it. It'll be, at least for me anyway, it'll start to become pretty obvious. And again, if you're looking at the numbers that come out on a monthly basis, you'll see it happening there too. Now, I'll make one last point, but essentially we talked about the news and how we're being bombarded with the amount of news we have and things like that. And the problem is, again, you hear stories and you hear one point of view, you hear the other point of view. It's all over the place, and but honestly, I have CNBC on at work, and I turn the volume down. So I don't even listen. I just watch what's going on, and if something interesting looks like it's come up, I might turn the volume up. But it truly is a disservice to people to try and listen to all these opinions and hear all this news and everything. It's just it makes it very hard to take a long-term perspective on things.
Absolutely. Well, Art Jarvis, thank you again for joining us on, this week's edition of Taking Stock with Art Jarvis, and we'll look forward to talking with you again in 2 weeks. Thank you very much.
Thank you, Chuck. I truly do enjoy this, so I appreciate it.
You bet. Thank you. Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.